there's no average or standard. I hear founders a lot saying, we're a seed funded company. Shouldn't we be X percent of our preferred price? Why is that different from company to company? What are the factors that go in that could make that change?
Yeah. So I think there's this little golden number that everyone talks about. I think it's somewhere around the 60%, the 30 to 60% that people usually think of. And it's not, that number did come from, proper valuation reports that's been done. It's a proper trend that has been observed, but it's not really a hard or fast rule, because where this discount actually stems from, I think we touched a little bit earlier, it comes from the difference in rights that the different share classes have. So with the investors having the preferred stock versus the employees getting the common stock, that difference in rights is what actually results in that difference in the value, so that discount. So why the discount can differ across multiple companies in different situations here, it really just stems down to what the cap table of your company looks like. So if you have a lot of different kinds of preferred shares with different rights, so maybe you have your Series A shares and your seed shares and some angel shares as well, of which, the Series A is better than the seed, and then the seed's better than the angel, and the angel's better than the common. In this case, because there are more layers in between the best preferred stock and the common stock, the price of the common stock naturally tends to get pressed down even lower. So the difference between the Series A stock and the common stock's price tends to be a lot larger than if it were just, a seed and common stock here. So that is where the difference stems from. But, this is really just one of the largest factors. There's also a couple of other smaller factors that could come into play as well.
Gotcha. And how does this get impacted when, for example, I have a down round, or even are there situations where I could raise capital, but the A price gets lower, even though I've raised more capital, maybe even at a higher price? Do they necessarily track?
It's possible for this to happen. We would say generally it's pretty rare. It usually only happens if, I would say the two most common scenarios would be one whereby if you do raise more capital, but the price difference isn't really that large from the previous round, such that your effective equity value really isn't going up, then that could cause the common stock price to effectively look lower than the previous one. Another scenario this could happen is if, markets are just really terrible and you just kind of raise at a very bad time, then naturally, even if your funding round looks pretty all right, pretty decent, it is still affected by market movements, and that could cause the price of the common stock to be lower as well. So mix of factors, these are the two most common reasons. But ultimately, I would say it's not something to really panic too much about. It is just really like the markets go up, markets go down, things can happen. And with early stage companies, things are always very volatile. So it's not something that sticks out as a huge red flag to people in the industry.